Hey everybody, this is Brian, and we're here today to talk about liquidity and volatility. Now, before we get started, as you're already aware, I do a lot of training with Complete Currency Trader, James Edward, and actually run his live training rooms. So everything that I do on this website really is a 30,000-foot overview that I want to get you interested in trading, want to help you with some of the fundamental aspects of how the markets work and how you can put the odds in your favor by applying the real mathematical advantages that you have in the marketplace. Now, with Complete Currency Trader, as I said, I run the live training rooms, and what we're going to see here today is a part of a training that I did for our members that just taught a little bit about how the markets actually work and why we need to be aware of certain market mechanics. Now, the more we understand about the markets, the better that we're able to execute our advantage and put the odds in our favor as we're trading. Now, if you would like to learn more about that, there's a link below this video. You can click that and get enrolled in one of the free courses that we offer from Complete Currency Trader, and then from there continue to build your knowledge with even more in-depth information than what I'm providing here. Now, before we get started into our actual training, I do have to let you know that trading does involve risk, and you need to double check and triple check your own emotions, make sure that you understand what your investment objectives are and your level of risk appetite and your level of training. Training is huge. Mindset is huge, and we'll talk more about that in our future classes. But for now, just know that it does involve risk, and if you'd like to read a full disclaimer about trading, and you can do so by going to CompleteCurrencyTrader.com/disclaimer.php. We're not actually talking about trades today. There's no live trades that we're going to be taking today. Is information only. So the top part of this disclaimer I have up for you right now doesn't really apply because we're not talking about any live trades. But at any rate, do know that trading does involve risk. Do know that Forex trading does have a high level of risk because of the leverage that's involved there. Leverage is great. It can work for you, but it can also work against you, and you really need to understand what those things are and how they work before you start trading. All right, let's get into the good stuff, the meat of this whole thing. Liquidity and volatility. What are they? Well, very root of it, liquidity is what makes the market work. It's a key characteristic of a good, well-functioning market. It's what enables us to trade. If there's no liquidity, there's nothing to trade. We need sellers in order to have buyers. We need buyers in order to have sellers. If they're not there, then no transactions can take place. Nothing can happen. Some markets that are very liquid, Forex. We know Forex, most liquid market on earth. Some very illiquid markets, penny stocks. Penny stocks, I know a lot of folks like to trade them. They're great things to trade, but also understand that there's not always somebody on the other side to take that trade. Just because you're offering it for sale doesn't mean that there's somebody there to buy it. Or just because you want to buy it doesn't mean that there's anyone there to sell it to you. So those are examples of an illiquid market. Volatility is important to understand because it's how we determine what our risks and rewards are in the marketplace. Volatility plays a very key role, and liquidity and volatility really work together hand in hand, and we're going to get into more of that here in just a moment. So let's dive into liquidity. And now again, this is a 30,000-foot overview. I want to give you information that helps you along and helps you understand it, but also I want to give you information that will inspire you to want to learn more about what liquidity actually is, what volatility actually is, and how it works and how it plays into your trading. So this is a 30,000-foot overview. You're going to keep this very quick, maybe about 10 minutes at the most, that we're going to talk about this stuff, and then we can dive into more in later classes. So the ability to trade a large size very quickly at a low cost when we want to trade it. That's what liquidity is. That's it, nothing more. It's the ability for us to trade at a low cost when we want to trade it. It means that we've got buyers looking for sellers, and we've got sellers looking for buyers. The more that we have of each of those, the more liquidity that there is. Now, there's three dimensions to liquidity, and it's very important to understand because we're all going to have different roles depending on what type of a trading style that we're using. And it's important to understand what the different levels of liquidity are, because they mean different things to different people, right? So the first level or dimension of liquidity is the immediacy. And what that means is it's how quickly a trade of a certain size can be executed. The people that would be interested in this would be impatient traders that are using market orders. They want to be in right now. And impatient, I'm doing air quotes over here, which obviously you can't see. Impatient doesn't mean necessarily a bad thing. It just means that a trader might see price coming to a certain level, or might see certain things happening in the marketplace, and they want to be in right now. They're using market orders. They're not setting pending orders and waiting for the market to move to them. They're using market orders. They want to be in right now, so they have immediacy. So that's a dimension of liquidity that they demand, right? They want to get in right now at the price that they want before the market moves again. So you need to have a very liquid market that's providing enough depth in order flow to get them in at that price. The next thing that traders are concerned about, or the next dimension that we should be concerned about as traders, would be the width or the breadth of the market. And that's just simply the cost of doing business. It's the cost of entering a trade of any given size. And the cost is primarily the bid and the ask spread. So it's the difference between the bid point and the ask point. And then that also includes broker commissions as well, of course. But the cost is very important. It might be the deciding factor between two pairs that we might be wanting to trade. We might be looking at, just to keep things simple, we might be looking at trading the Euro USD, and we also might be looking at a potential trade on, let's say, the pound New Zealand, right, or the New Zealand CAD. We're going to see a smaller spread on the Euro USD than we might on the New Zealand pair. And knowing that, understanding what that cost is, might be the deciding factor between which one we trade. It may cost us more to trade that New Zealand currency, so we're going to stick with the trade setup that we're seeing on the Euro USD. It's just a factor of the marketplace that helps us decide what to trade. Another dimension that we might be concerned about as traders. And then finally, we mentioned it earlier, the depth of the market. And this is the size of a trade that can be arranged at any given cost. And this is very important as well, because this means how much of a currency can actually be traded at a set price. Now, if you watched previous videos, you already understand that one of the reasons that the market moves is because price at a certain level has been absorbed. So if there's not a whole lot of liquidity at a certain level, and it's all absorbed by one order, then price is going to move to the next level in order to fill that, the rest of that order, fill that void. So very, very important, those three dimensions. And each trader is going to have different reasons for maybe wanting to focus on one or two or maybe all three of those things. Each dimension is going to mean a different thing to a different trader. So what's it all mean? Well, again, we have to understand all three types of the dimensions so that we can really see what it means to us. A few traders are concerned with only one level of liquidity. For example, a small volume intraday trader will probably be very focused on the immediacy of getting orders filled before the market moves. So for them, when they refer to liquidity, they're referring to the speed of getting an order filled. I mean, again, coming back to the real market, there's a huge difference in the speed of getting your order executed, at 8 a.m. Eastern time, when we have the U.S. market overlapping. It's just opening up, and we've got the London and European markets that are open. You have a lot of traders in right then, so your orders can be filled very quickly. But if you were to put an order in at, let's say, 5:30 p.m. Eastern time, there wouldn't be as much liquidity. The U.S. market has closed, and all you have open at that point is the Sydney market. So there's not as much liquidity. It may take longer for your order to be filled. So a small volume intraday trader may want to trade during the periods when they have a faster speed of execution. Traders that are trading a large volume of currencies, they'll be more concerned with the depth of the market, because they're trying to get a large order in without incurring a lot of slippage, right? And again, understanding how the market moves. If there is a limited amount at one price and we absorb all of that, then price has to move to the next level. So traders that are trading huge volumes are very concerned with how much is available at each level so that they can get into that trade at the price that they want, when they want, without having the price slip against them as their order is filled. So they're concerned with the depth of the market. And then there are other traders, of course, that are just simply concerned about the cost, and therefore they're looking at spreads more than they're looking at immediacy of entry or the time of or the depth of entry. They're worried about a tighter spread versus a more costly spread, a wider spread. So they're all going to have different reasons for trading in different ways. Liquidity, depending on what we're trying to accomplish, is going to mean different things to each of us. So, I mean, to make it easy, liquidity, it means we can enter the trade that we want to at the price that we want to in the size that we want to, and that's what liquidity is. Liquidity is not a constant. It's not something that's always there. I mean, of course, as banks, as businesses, as individuals trade with each other, liquidity increases and decreases. Time of day, overlap of markets, these things all play a factor into the liquidity that's available to us. Obviously, you know, when the Australian, New Zealand, Asian markets are open, we may see increased liquidity in Aussie, New Zealand, yen currencies during market hours for trading the pound, the euro. We're going to see increased liquidity in those currencies. It's going to ebb and flow, and understanding that helps us understand when we want to trade and understanding what our objectives are with trading. It's key to that, and it's kind of easy for us to gauge how much liquidity is there simply by looking at spread. Spreads widen as there's less liquidity. There's more risk for the market makers. So obviously the spreads are wider because they have to protect themselves on either side of those trades. So they're going to have different levels at which they're willing to buy or sell at because they can't be filled as quickly with limited liquidity, and could get overexposed to one side or the other very, very quickly. So, it's very easy to gauge levels of liquidity in the marketplace just by looking at the spread. Pairs that are less liquid have higher spreads. Pairs that are more liquid have lower spreads. I mean, again, coming back to the earlier example, the Euro USD. Euro USD is the most traded currency pair. It has a very low spread comparatively. If we go and look at something like a CAD, like the New Zealand CAD, it's going to have a higher spread than the Euro will, just because there's less liquidity there. And we know, again, slippage, partial fills, those are going to occur because there's a lack of market depth. So there we have it. That's liquidity in kind of a nutshell. 30,000-foot overview. So how does volatility play into this? Well, again, liquidity is linked to volatility. They're inseparable. They're kind of a package deal. Volatility is the tendency for prices to change rapidly or unexpectedly, and those prices can change in response to new information about fundamental values, news releases, regarding interest rates or economic policies, employment rates, things of that nature. But they can also change in response to demands of the traders that are consuming liquidity. So price is going to move for two different reasons. We talked about that in previous videos. We'll talk about it again as we dive more into the depth of each of these things. But ultimately, there's two types of causes for volatility. There's fundamental and there's transitory. Fundamental volatility and transitory volatility. So the volatility, fundamental volatility, is what happens when we have news reports, things of that nature, that cause an impact to price, right? We have the fundamental value of the currency is impacted by what a certain country is doing with their interest rates or their economic policies, or what employment is doing, capital, trade flows, things of that nature, national debt. Those things will impact the fundamental value of that currency. But then there's also other unexpected unexpected changes. We have the transitory volatility, and that's when we have traders that are absorbing the liquidity that's there very rapidly. Maybe they're trading, right on news, or maybe they're uninformed. They might be looking at something in the marketplace and making decisions, and they're just absorbing the liquidity that exists. As they absorb that liquidity, prices are going to move because we're absorbing what's available at a certain level, and we're forcing price to the next level, the next level, the next level. This is what that quote whip is in the marketplace, and we see this during times of news releases. The non-farm payroll, the NFP release that occurs every month, is a great time to watch this, because often what happens is we see market makers limit the liquidity that's available because they don't want to be overexposed with the news release. So there's a very limited amount of volatility of liquidity that's there in the marketplace. The news release comes out. The impatient traders immediately will decipher the direction they think that's going to move based on the announcement that was made, and they will absorb the liquidity. So they're going to all enter buys. Bang, 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 bang. We have these buys entering. Boom, price moves because there's very, very limited liquidity in the marketplace, because the market makers are there to protect themselves. They're not offering a whole lot of bids or offers on either side of where price currently is, because they don't know what the release is going to say. So they have limited liquidity in the marketplace. That liquidity is absorbed very quickly by impatient traders, and it causes price to move, either up or down. Doesn't really matter, but it causes price to move. Well, over time, usually about 15 to 20 minutes after that news release has occurred, the market makers begin stepping back in, and we'll see price revert back to its true fundamental value. So we see that whip occur because of the transitory volatility. So dramatic whipsaws, again, they're caused by dealers withdrawing liquidity from the marketplace, and that's followed by impatient traders reacting emotionally or irrationally, pushing prices away from their fundamental values. And then we have the informed traders that come back and counter that irrational move and push prices back to their real perceived values. Often when this occurs, you hear people, and even if this occurs, it occurs all the time through the markets, and it's not always around news. We'll see this happen, just during the course of a regular trading day. There are orders, there are pending orders that are constantly put in, and market makers are changing where they're willing to buy or sell at. Well, if at any point there becomes a slight imbalance, and all of the orders are absorbed at a certain level, price will rapidly move in one direction or the other, causing a bit of a whip. Well, we often hear people say, "Oh, that was stop hunting," or some sort of a pre-planned activity by the larger traders. It's not. It's a simple nature of how the market works and how it works with liquidity and volatility. So it's not any kind of a grand scheme. It's just simply how the market works will cause it to rapidly move up and then float back down. And again, we understand that from looking at previous videos of what I've talked about when we're trying to gain our trading edge and taking advantage of those imbalances as they occur. So let's go ahead and wrap it up. Just to sum it up very quickly for you, the role of liquidity really is probably one of the least understood mechanics of the market, but it's a very, very, very important aspect of trading, because understanding liquidity impacts when we can trade, how much we can trade, and what it's going to cost us to trade it. Liquidity can even cause prices to move without any buying or selling taking place, as market makers are changing the levels at which they're willing to buy or sell at. Prices can fluctuate up and down. And that volatility exaggerates that by exaggerating our risk and our potential rewards. And this is one of the biggest defining characteristics of Forex. And as we understand how these two things work in tandem, how they work in conjunction with one another, really helps us understand what's happening in the marketplace, and most importantly, why it's happening. Oftentimes we see price moving, it's moving up, it's moving down very drastically, and understanding why that's happening can really provide us with a new level of calm as we approach the markets and try to execute our edge in the marketplace. So there you have it. That's liquidity and volatility. If you'd like to learn more, please click the link below this video, and you'll be taken over to our official site for Complete Currency Trader, and you'll be able to register there and get into a really nice series from James where he dives into some additional mechanics of the marketplace and even provides you with a system and some free tools that you can trade to help you get on the right path to profitability and consistency in the marketplace. So thank you very much for watching the video. Thanks for being here on the website, and I hope to see you in some of our live classes with Complete Currency Trader. All right, have a great day.